So sometimes what happens is that you buy a stock and the stock breaks out of the pivot point. However, it does not follow through. It comes down. Probably it hits your stop loss, or probably you cut the position before even it hits the stop loss. However, if you keep an eye on the stock, if you closely observe the price movement, and if the base and everything remains intact, the stock will usually give you another buy point, which is exactly what happened here. And I will discuss this with you. This is Dixon Technologies. I had made a video on this a few days ago where I had booked around 2 to 3% loss. I will explain that. Currently, I am in the position, so please don't consider this as some recommendation or something. I generally make videos after at least a couple of weeks have passed when I have already made the purchase. So that way I try to avoid, implying that I'm giving any recommendation or something. Okay. So I bought this stock on this day, which is 16th of September. And I'm recording this video on 27th of September. So quite a few days have passed. So that is why I like to make videos where, I'm not buying it live. So that's my way of telling the story of a particular trade. So let's look at this stock. So first thing, let me hide the moving averages. By the way, you look at all these moving averages, it's a nice stage 2 uptrending stock. I will hide all these moving averages for you. Now, have a look at this. First, I bought the stock on this day. And then on this day, I exited the stock because it broke this level. It was a tight price action here, so I had bought it here. So I booked 2-3% loss. But then what happened is, it came down, okay? Ignore this red line. It came down, started going up and started forming these two tight candles here, okay? And that was a signal that the stock is setting up a new buy point. See, this decline was not severe enough to cancel out this base. See, the low of this base is here. So this decline stops here itself. It doesn't come down all the way and take out this low. So which means the base is still valid. The base has not failed. What has failed is the pivot point or the buy point. There was a buy point here. Okay, that buy point has failed. And since the buy point has failed, I had to book a 2-3% loss. But then the buy point set up again. This is called as a pivot failure reset. Let me repeat. This is called as pivot failure reset. Now, the reference to this book is given, the reference to this concept is given in Mark Minervini's book, Trade Like a Stock Market Wizard. It's the first book that he wrote. And let's refer to a page in that book. Let me show you that. See, you look at this base, okay? It breaks out, it squats. Squats means it goes up and then comes down, closes below that dotted line. So that base buy point has failed. However, if you see the stock comes down, okay, forms another pivot point here and then goes up on high volume. Now this shakeout is here, but this is not the entire base. This is the base. This dotted line is shown here. So this shakeout has not taken out this particular low. See, you see this part has been zoomed in here. Okay. So this is exactly what you see happening here. So first it breaks out, then comes down, doesn't take out the low, and then forms two tight candles here. So you get the buy point. So the high of either one of these candles is your buy point. And immediately the next day, as it crossed that yellow line, I bought the stock. I put 5% of my portfolio in that stock. And ever since that time, it's been up like 9-10% roughly. Now, the question is, why did I buy the stock? Why am I so adamant about buying this stock, even if it had kicked me out at a small stop loss? And the answer is very simple. Look at the fundamentals. See, 83 is the master score. Master score is a scoring given by MarketSmith to a particular company based on its fundamental and technical factors. Okay. Anything above 60 is considered to be excellent. So this is 83, which is fantastic. 95 is the earnings strength. Here, what MarketSmith is doing is they are looking at the earnings stability, earnings growth, quarterly, annually, and earnings consistency. And they compare the performance of that stock, looking at these factors, with all the other stocks in the Indian stock market. So 95 means this stock has done better than all the other stocks in the Indian stock market when it comes to earnings, stability, consistency, growth, annual performance, quarterly performance. There are a lot of factors go into this calculation. Excellent. 85 is the price strength. So you compare the 52-week performance of this stock with the 52-week performance of all the other stocks in the Indian stock market. 85 means Dixon has done better than 85% of all the stocks in the Indian stock market on a 52-week performance basis. Again, another excellent rating. B means institutional demand. Any rating which is A or B indicates institutional demand. 28 is the group rank. So there are total 197 industry groups. Any rank which is less than 40 is considered to be very good. 107 is the recent quarterly earnings growth. Recent quarterly earnings growth means you look at the earnings of current quarter and compare the earnings of current quarter with the same quarter last year. Okay, that's 100%. So the earnings have doubled. Similarly, sales growth 101%. This is quarterly sales growth. You look at the sales made by the company in this particular quarter, current quarter, and you compare that with the same quarter last year, you see the earnings, the sales have also doubled. Then you have return on equity. Anything more than 17% is excellent. This is 22%. Okay. 3 is the the base count. At what stage am I buying the stock? Am I buying it early stage? Am I buying it in the middle stage? Or am I buying it in the late stage? Okay. So that's what this number indicates. These are my notes basically. Okay. I take this from MarketSmith. So this is base 3, which means I am buying at the middle stage. I am not buying too late. I am not buying too early. I am buying it in the middle. So the risk is slightly higher. Generally, it is recommended to buy when the stock is in base 1 and base 2. That's when we can ride the stock for a long period of time, provided the fundamentals of the stock continue to improve. Okay. And then 4, I forgot what this number was. I don't remember. Anyways, let's see. If I remember in some other later video, I will tell you. Maybe this has got to do with some time frame or something. I don't remember. Anyways, so this is how the stock is placed. And I bought the stock here early in the morning when the market opened. The price was hovering somewhere around here. I put 5% and I put an 8% stop loss. This red line is not at the low of this. This red line is at 8% below my yellow line. Okay. And since 16th of September, the stock has been nudging up nicely. The volume has not been great. So it is consolidating. Maybe it is creating its first natural reaction. After this, if it provides a nice big green candle, immediately my stop loss would be either at 4% or at break even. So that's my strategy. So currently I'm sitting on the stock. I have not sold a single share. If the stock continues to do well, if fundamentals remain strong, then chances are very low that I will end up selling the stock too soon, because this is a market leader. It it's an electronics contract manufacturer. It has clients like HP, Lenovo, Asus, Acer. Every other day, I read in the newspaper that the company has received an order from a new client. Then the company also benefits from some production linked incentive scheme from the government of India. The margin of this company is very low, is less than 3%, but there is assured business. Okay, even if the margin is low, if there is assured business, you can see the growth in the numbers. So a little bit of detective work if you do around a position that you have, it might help. You don't have to read the entire annual report. Okay. Plus, one shortcut I can give you, there are YouTube channels where people do a proper left, right, center fundamental analysis of stocks. Okay. So if I have bought this stock, rather than reading the entire annual report or reading the conference calls or brokerage reports, why not just go to one of these YouTube channels where this company, the business model of the company, the clients, the revenue, everything is discussed properly in terms of fundamental analysis. Within 10-15 minutes, you get a very nice background or overview about the company. So you know very well about a company, you understand the technicals, you have the market Smith ratings with you, you have the moving averages, you understand price volume action. Okay, you know how to do base counting. When you know all of this is called taking a position, taking an educated guess on a particular stock. You are not betting your money on any stock. You are looking at all the factors, and then you are deciding that you want to stay with a stock, because staying with a stock is also like taking a position. Okay. So that's a decision you are taking to stay with the stock. Tomorrow, if this collapses 8%, you are responsible, right? So you have to take that responsibility. Okay. So I hope this video has been helpful. And as this stock, as the story of this stock continues, I will continue to make more videos on the same stock, because I like to tell stories about the stocks that I own. But after I have bought the stock, not before or while I am buying the stock. That is not the right way uh, to do, because I don't give investment tips or advice or recommendations or anything. I like to tell stories. Okay. So thank you so much